Welcome to TSAT. We are discussing about monetary policy. We already has completed part 1 of monetary policy, and in the first part of monetary policy we discussed about what is the definition of monetary policy, the objectives of monetary policy, and who formulates and reviews the monetary policy, with what particular frequency the RBI and its team, the monetary policy committee, reviews the monetary policy. And later we also discussed about various functions RBI performs other than formulating and reviewing this monetary policy, isn't it? Now let's go ahead and look at the most important part of monetary policy, that is the policy instrument that RBI has at its disposal to control the supply of money, or to control or to alter the interest rates in the economy, and thereby the achieve the objectives, broader objectives of growth and contain price, inflation and deflation in the economy. So now let's go ahead with the various tools or instruments of monetary policy. Broadly, we divide the tools of monetary policy into two different types: quantitative and qualitative. Quantitative and qualitative. Quantitative and qualitative. So if you look at quantitative tools, quantity, that explains the fact that any tools, when it comes to quantitative, they are going to alter the amount of money, the amount of money supply. The amount of money supply. So either that results in increase in money supply, the quantity of money supply, or that would reduce the amount of money supply in the economy. But what do you mean by qualitative tools of monetary policy? Is there a good quality currency and bad quality currency? No. When it comes to qualitative tools of monetary policy, what would be the part of qualitative tools of monetary policy, or what do you mean by qualitative method? So I'll just give you some examples so that you could be able to figure out what exactly is the qualitative tools of monetary policy. So something like selective credit control. Selective credit control. So RBI. So in fact, there are lot many instruments of monetary policy which happens to alter the quality of money supply. So what does these particular qualitative tools does mean? Now you must imagine the RBI happened to tell the banker, so these are the particular sectors that requires credit support. These are the tech sectors that requires some financial support. Henceforth, it would be better to concentrate or simply disburse certain amount of loans to these people, rather than certain other sectors of the economy. So if RBI is trying to influence the credit supply by simply simply giving certain conditions, or simply helping the banks to disburse credit to certain sectors for the sake of promoting various development activities, in such case we happen to call such kind of tools of monetary policy as qualitative tools of monetary policy. So the quantity of money remains the same, but which particular sector gets the credit and who gets the preference than compared to other, and these kind of tools or initiatives of RBI is generally what we happen to categorize as qualitative tools of monetary policy. I have just given one example, and there have been ample number of such kind of initiatives by RBI which disburses or which helps the banks, or which results in the banks simply taking certain importance compared to various other sectors, and that's what will be part of qualitative tools of monetary policy. Now let's go ahead and try to understand how in reality this so-called banking system along with RBI would help in increasing the supply of money or altering the supply of money. So basically we all know that, just imagine, not only RBI is into the business of controlling and supplying money, even banks play a very important role in influencing the supply of money. So though RBI is the only one which has the right to print and circulate money, but banks in reality would also play a very important role in creating or in increasing the supply of money. That's what just I am trying to explain you in this in a very brief 2-3 minutes. Now just suppose someone happens to invest some 1,000 rupees in a bank, and when the RBI tells the bankers, they go please do ensure that every bank, whoever accepts deposit, has to maintain some reserves. Why should a bank has to maintain some reserves? Because if a bank accepts a deposit and lends all money to certain other people, lends money to someone who is interested in borrowing, and one fine day the one who deposited money walks into the bank and simply says, I am willing to borrow, or I would like to withdraw certain amount of money, and bank cannot afford to say, I am sorry, I don't have any money, all the money that I happen to accept from you as a deposit has been disbursed as a credit to someone else, and I cannot afford to give you or keep the promise of giving you certain amount of money from your deposit, isn't it? So henceforth the banks always need to maintain certain amount of reserves out of the total deposits, because the banks also need some money okay, for the purpose of serving the interests of the customers. So henceforth, banks cannot afford to lend all the money they accept from the customers as deposits, and at the same time it doesn't make sense banks to keep all the money they accept from deposits as reserves. So it does mean banks cannot maintain 0% reserves and banks cannot maintain 100% reserves. So every bank is expected to maintain certain amount of cash in the form of reserves out of the deposit that the banks accept. In general, in India, it is the RBI who determines how much is the reserve the bank has to maintain out of the total deposits. Now, let's say in this example, the RBI has mandated the banks to maintain 10% of their deposit as reserves. Now, let's see how this reserve banking cycle would help in banks creating more supply of money and creating more and more credit supply. So, now imagine a person deposited 1000 rupees, and out of 1000 rupees, since the banks are mandated to maintain 10% of deposits as reserves, the banks need to keep aside 100 rupees out of 1000 rupees, and the banks now could only lend some 900 rupees out of 1000 rupees. And now let's say this 900 rupees is money that has been borrowed by this particular person, and this person again spends this money, and once this person spends this money and that particular money flows to a different bank. Just imagine this man happened to go to this market and he happened to spend this money, and whoever received this money has deposited the 900 rupees in a different bank. And out of this 900 rupees in a different bank, now this bank has to again maintain 10% of its deposit as reserves. Does mean it need to maintain some 90 rupees out of it as reserves and could only lend 810 rupees it received from the deposit holder. So now out of 810 rupees, imagine this 810 rupees is borrowed by this third person, and this third person again goes and spends it in the market. Now that person who received this 810 again approaches a different bank, and just imagine that particular bank maintains again 10% of reserves, that is 81 rupees, and the rest of 729 rupees is what is being lent to a fourth person. If this cycle keeps going on, if you look at, you might have noticed the fact the total money supply within the bank. Look at, in the first case, the bank has a 1000 rupees deposit. In the second case, this bank received a 900 rupees deposit. In the third case, this bank has received a 810 rupees. And when this man spends and the fourth person spends, this particular money would be reached or would be deposited in some other bank. So that's how the supply of money in the economy would keep increasing. That would be 1000 plus 900 plus 810 plus 729, and this cycle keeps on going up to infinity. And if you could look at the total money supply at the end of the day would be equal to somewhere around 10,000. And this could be calculated by a simple formula. The total money supply is equal to the money that RBI print circulates, what we call M0, high powered money, multiplied by the reserve 1 by RR. So this is how we would be calculating the total money supply. So when the reserve ratio is 10%, and for every 1000 rupees printed and circulated, the total money supply would be 1000 multiplied by 1 by 10. That's going to be 10,000. So if I think you might have understood, but at least I would suggest you to remember this formula, and I just want you to understand the fact that the banks do also play a very important role in creating credit, thereby resulting increase in supply of money. So whatever the money the RBI prints and circulates in the economy, the money doesn't remain the same amount. The money gets multiplied once it is been into once it turns to become deposit and enters into the banking system. So this is how banks also play a very important role in creating credit and thereby creating increasing the supply of money. Now let's look at certain important reserve ratios the bank has to maintain, and please don't ignore this number 3%. I just simply has taken some random number to let you understand it. It's not necessary the cash reserve ratio is 3% as of now. In fact, it is more than 3%, but let's not by heart the exact amount of the cash reserve ratio, because as I already made it clear, the RBI has a right to review the policy at any point, ideally once in every 2 months, and the RBI, based upon the requirements on the economy, the RBI could make the changes in the policy rates. But here in this example, I am just assuming, let's say 3% or 4% or 5%, whatever it could be. But before going into it, let me define what exactly is a cash reserve ratio. As I already mentioned in the last slide, that reserve ratio is something every bank is bound to maintain, because without maintaining reserve, the bank cannot sustain or the bank cannot meet its requirements of various customers. Henceforth, it is a very common practice. In fact, reserve ratio or reserve banking practice is a universal near universal banking practice. Banks across the world are bound to maintain certain reserves. So in India, if you look at not only India, most of the nations, it is the central bankers are the one who happen to regulate the banking industry, are the one who determines the reserve the banks has to maintain. So in India, broadly, we do have two different types of reserve ratios maintained by the banks. One is the cash reserve ratio. The second is the statutory liquidity ratio. So how would you define a cash reserve ratio? Cash reserve ratio refers to the percentage of net demand and time liabilities. So I am writing it as a NDTL. Okay, NDTL stands for net demand and time liabilities, the percentage of net demand and time liabilities. So what do you mean by net demand and time liability? So let me make it clear. What is the liability of a bank? What is the liability of a bank? I think you understand the difference between asset and a liability. Asset simply does mean anything that has a value, okay, anything that's precious and has a value and you own it is an asset. Anything that has value and you owe to others, anything that you owe to others, I mean you are liable to pay back, give back something to others, then we call it a liability. So if you look at for a bank, what are the assets of a bank? The assets of a bank are loans extended, because any amount of money the bank extends as a loan is the money that comes back to the bank, okay, along with certain amount of interest, mostly the lending rate of interest the banks charge upon the loans. So henceforth, all the loans the bank extends to the customers are generally considered as assets of the bank. And what comes under the liability of a bank? Okay, any amount of money bank accepts as deposit, because once a bank accepts a deposit from any of the customer, what is the bank promising? Okay, this money that I accept as a form of deposit from you is what I would be paying you along with some rate of interest, generally what we call a saving rate of interest. So in future you could take your money, and upon the money that you happen to park with me, you would be getting paid certain amount of saving rate of interest. Henceforth, now it's an obligation upon the bank whichever accept deposit to pay back the money back, and henceforth this particular deposits accepted the bank is what we call as a liabilities. So now coming back to the meaning of the term net demand and time liabilities. So what is the liability? Deposits. And these deposits could be broadly, okay, of two different types. One is a term deposit, or what you people call as a fixed deposit or time deposit, and the other deposit could be a demand deposit. So henceforth, the simple meaning of the word NDTL corresponds to the total deposits. So you don't need to worry about the term NDTL. It simply in common, okay, in simple language, it simply does mean the total deposits. So how would you define cash reserve ratio? The percentage of net demand and time liabilities. It simply does mean the percentage of total deposits. I mean the percentage of total deposits that the banks has to maintain with RBI, that the bank has to maintain with RBI in the form of liquid cash. In the form of liquid cash, I mean in the form of simply some liquid cash. Okay, so is generally what we call as a cash reserve ratio. So now let's say, imagine there is a depositor that walks into a bank and makes a deposit of 10,000 rupees. And now the RBI mandate the banks to maintain a 3% of cash reserve ratio. In such case, what is the bank expected to do? It has to take 3% of 10,000 deposit and keep with RBI in the form of some liquid cash. So how does this help, or how do you think this would help in simply altering supply of money or altering supply of credit? Now just imagine, out of 10,000 rupees, if this bank ends up parking 300 rupees, now the bank would only lend 9,700 rupees to the market. Okay, so because 300 rupees has been kept aside in the form of cash with the RBI, and this 300 rupees is what the bank could not afford to lend. So what happened? It accepted 10,000 rupees, but could only lend 9,700. So higher is the CRR, I mean more is the CRR, lesser is the money the bank has to lend, isn't it? Now let's say if the CRR is 10%, in such case the bank is bound to maintain 1,000 rupees with the RBI. Now the bank would only have 9,000 rupees to lend. So what does it mean? More is the reserve ratio, or more is the cash reserve ratio the banks is expected to maintain, lesser is the money the bank has to, to lend, and henceforth higher reserve ratio results in less money supply or less credit supply, isn't it? Because it could only lend less money because of high reserve ratio, and lesser is the reserve ratio, more is the money it could lend as a credit. I mean more is the money it could lend to the market, and that is how reserve ratio, or here in this case cash reserve ratio, plays a very instrumental role in altering the supply of money. So I just want you to remember the fact, okay, with increase in reserve ratio, this bank's ability to lend money decreases, and with the decrease in reserve ratio, the bank's ability to lend money increases, isn't it? So it would have more and more money to lend because of less reserves it has to maintain. That's the one particular importance of cash reserve ratio. And the second important reserve ratio in India happens to be statutory liquidity ratio. Again, this again is a random number, 18% I happen to choose, but you don't need to worry about this particular number. As such, I said any of these policy rates, whether it's a CRR, SLR, or the next particular rates that we'll be discussing, like liquidity distribution facility, repo rates, policy rates, okay, I mean bank rate, Any such rates is what the RBI could change at any point of time, not necessarily they happens to be constant forever and ever, isn't it? So here in this case I have taken some random number 18%. So when I say statutory liquidity ratio, it is one type of reserve ratio, and I guess you know the meaning of the word statute. Statute does mean by law or by order. So now when the bank, when RBI happens to tell these banks beyond cash reserve ratio, every bank is expected to maintain some X% of their total deposits, or what you call net demand and time liabilities. So how would you define SLR? It's the percentage of total or percentage of net demand and time liabilities the bank has to maintain in certain liquid form with the themselves. Okay, so I mean the proportion of deposit the banks are expected to maintain in certain liquid form, So in what form as of now the banks in India are expected to meet the SLR requirement? As of now in India, the RBI allows the banks to meet the SLR in three different forms. One is in the form of gold, the second is in the form of forex, foreign currency, mostly hard currencies, and the third could be government approved securities. So simply speaking, what is the RBI telling the banks is, along with cash reserve ratio, my dear banks, every time you accept certain amount of money in the form of deposits, some X%, some X%, let's say in this example, some 18% of your deposits should be converted and maintained with you in the form of either gold or in the form of foreign currency, I mean forex reserves, or in the form of government approved securities. I mean you need to buy certain securities approved by the government of India. So it's not necessary that you need to maintain all 18% only in one form. So but you out of total deposit, 18% of it has to be, in this example, 18% minimum has to be maintained in any of these three forms. So which form you would like to maintain, that's up to you, but in total, out of every 100 rupees you accept, 18% of it has to be converted into any of these kind of assets. So that's what the statutory liquidity ratio. And I think now you could simply understand the fact, higher is the SLR, I mean more is the SLR the banks are obliged to maintain, lesser is the money the bank has to lend, isn't it? Now imagine if the SLR is 40%, does mean 40% of the money gets converted into any of these three assets. Now the bank only has 60% of total deposit to lend. Whereas the SLR is only 4%, now the bank has 96% of its deposits to lend. So higher is the SLR, lesser is the money to lend, lesser is the SLR, more is the money to lend, and that's how even statutory liquidity ratio or SLR do also play a very crucial role or very important role in altering the supply of money. So whenever the banks are being mandated to maintain high SLR, they would have less money to lend. Whenever the banks are expected to maintain less SLR, they have more money to lend, and that is how by RBI, by influencing or by altering SLR, could also influence the supply of money and supply of credit. That's the other important tool of monetary policy. That's a statutory liquidity ratio. So these are two prominent reserve ratios that banks in India are expected to maintain as per RBI. So I'm just simply trying to consolidate what exactly is the CRR and SLR. So if you look at, out of every 1000 rupees they need to maintain, and as such I already made it clear that CRR and SLR, when I say 6%, 6% of top CRR is 6%, has been 6% of total deposit the bank has to maintain, and when I say SLR of 20%, 20% of total deposits is what the bank has to maintain in the form of SLR. So in total 60 rupees has to be kept aside in the form of cash, and when SLR is 20%, 200 rupees out of total deposit has to be maintained in any of these three forms of liquid assets, mostly in the gold, government approved securities, or forex. Forex, when I mean to say mostly the hard currencies. When I say hard currency, the meaning of the word hard currency is the currencies that are highly in demand and globally accepted or universally accepted. Generally, as of now, we refer hard currencies does mean dollar, euro, pound sterling, yen, Japanese yen, and Chinese yuan or renminbi. So these are generally these five different currencies: dollar, euro, pound sterling, Japanese yen, Chinese yuan, or renminbi. When it comes to Chinese currency, people say either yuan or renminbi. These five currencies are generally referred as hard currencies. Rest of other currencies are called soft currencies. So what is a hard currency? Currency that is almost acceptable across the globe. So you take a dollar and simply pay for something in some African country, people would be happy to accept it. These currencies have a universal acceptance. Such currencies are generally referred as hard currencies. So when RBI expects the banks to maintain certain amount of their particular reserves or certain amount of deposits in the form of foreign currencies, mostly the RBI is expected to maintain this SLR requirement either in the form of gold or any form of hard currencies or in the form of government approved securities. So that's what's the reserve ratio does mean, and as such you need to remember the fact whenever the reserve ratio, whether it is CRR, SLR increases, the banks would have less money to lend. That does mean the credit supply decreases. Whenever the reserve ratio decreases, the banks would have more money to lend and credit supply increases. That's one important thing that you need to remember for the exam. Now let's look at the other important tool of monetary policy, what is very prominently called as a liquidity adjustment facility. Liquidity adjustment facility. So you know what is liquidity, isn't it? So there are certain instruments of monetary policy wherein the banks and RBI together, could alter the supply of money, and one initiative that the RBI has introduced somewhere in the year of 1998 is very popular, known as liquidity adjustment facility. This is what what the banks and RBI achieve through operations called repo and reverse repo operations. So simply let me make it clear with simple definition. So repo rate is simply the rate at which RBI lends money to the banks. So like we happen to borrow money from a bank. Generally, if you or me, any one of us borrow money from banks, we would be charged some lending rate of interest. Similarly, as such, we already discussed, RBI acts as a banker to the banker. RBI acts as a banker to the banks, isn't it? So whenever these banks are interested or banks are in need of money, and if they would like to borrow money from RBI, and upon the money they borrow money from RBI, they would be charged certain rate of interest, and what is called as repo rate of interest. And in India, this repo rate of interest is what is very prominently referred as a policy rate of interest, because most of the other rates of interest are linked to the repo rate of interest, and that's a basic reason when it comes to repo rate of interest, it is also very popularly referred in India as a policy rate. So I mean the entire monetary policy more or less could be signaled using the change in the repo rate of interest. So something very similar to the lending rate of interest that we are expected to pay upon the loans we borrow. Similarly, repo rate of interest is the interest rate that the banks are expected to pay upon the loans they borrow from RBI. That's it. And reverse repo rate. So now I think you understand the fact that when the repo rate is increasing, so when the repo rate increases, I mean the rate of interest the RBI charges upon the loans to the bank increases. Now what happens? So now imagine this repo rate of interest, RRI, I am simply writing it in the short form. Repo rate of interest increases. I mean the rate at which RBI lends money to the banks increases. Then what would be the impact upon the lending rate of interest these bank charges to the customers? It would increase, because the money for the banks itself is going to be costly, henceforth they end up simply passing on the burden to the customers. So the rate of interest at which people borrow from the banks also increases. So as a result, one can usually understand the fact that whenever the RBI goes for increasing repo rate of interest, it is trying to signal the economy, or it is trying to pass on the information that I am willing to make money tight. I am just going to, my intention is to increase the rate of interest in the economy. And what do you think the RBI goes for increasing rate of interest in the economy? Ideally to contain inflation or keep the price rise under control, isn't it? Henceforth, whenever repo rate of interest increases, the cost of loans increases. These days you might be coming across in the newspaper, whenever RBI goes for change in policy rates and increases policy rates, the home loan rates of interest and other consumer loans of interest keeps increasing, because the loans are the rates of interest banks happens to charge upon the customers is anchored with the repo rate of interest, and this is what we call external benchmarking, isn't it? So that's how the RBI, by increasing repo rate of interest, trying to signal the market that the lending rate of interest would be costly, because the banks now end up charging higher rate of interest because the money from RBI itself has become costly. Similarly, whenever the RBI tries to reduce the repo rate of interest, so what is the RBI trying to signal? I am willing to lend money at a cheaper rate of interest, so that banks now borrow money from RBI at a cheaper rate of interest and pass on the same money at a much cheaper rate of interest to, relatively at cheaper rate of interest to the customers. So when RBI goes for increasing repo rate of interest, the lending rate of interest in the markets are bound to increase. When the RBI decreases the repo rate of interest, the lending rate of interest by the banks, charged by the banks to the markets decreases. So increase in repo rate is a tight money policy or a contractionary policy. Decrease in repo rate is a easy money policy, or what you call it expansionary policy. So now let's go ahead with the other part of liquidity adjustment facility, that is reverse repo rate. So as such, I already made it clear, repo rate is the rate at which RBI lends money to the banks. Now just look at it in the reverse way. So reverse repo rate is ideally is the rate at which RBI borrows money from banks or banks park their money with RBI. So it's as simple as that. When we borrow money from a bank, let's say here is a bank. When we borrow money from a bank, the bank charges lending rate of interest. Similarly, when we park money in a bank, we would be paid saving rate of interest, isn't it? So whenever we people borrow money from a bank, what happens? The banks promise, when we borrow money, the bank charges a lending rate of interest, isn't it? There is so it all depends upon the loan you borrow. Loan, gold loan, home loan, automobile loan. So on an average, there will be certain rate of interest charged. So upon the loans we borrow, we are expected to pay lending rate of interest. Upon the money we deposit, the bank promises us some saving rate of interest. The same logic similarly holds good. When the banks borrow money from RBI, they are charged repo rate. Upon the loans borrowed from RBI, they are charged repo rate. When the banks park money with RBI, or when the RBI borrows money, when the RBI borrows money from the banks, these banks are paid what is called reverse repo rate. Reverse repo rate. Now let's see how this reverse repo rate would help in altering the supply of money or altering supply of credit. Now just imagine if RBI one fine day tells the banks, if you are willing to park your money or if you are willing to lend money to me, I would like to pay you a very high rate of interest, a very high rate of interest. In such case, what is the RBI trying to signal to the banks? If you keep your money with me, you get paid more interest rate. In a way, the RBI is trying to tell the banks, it would be better to park your money because you get paid more interest rate. Whereas you lend the same money to the market, some of these people who borrow money might end up becoming defaulter, and there is a risk attached by lending money to these people. So henceforth, rather I would simply discourage you to lend money to the market, whether you, better you get paid more amount of interest rates if you keep your money with me. So in a way, the RBI by increasing reverse repo rate, trying to signal the banks that it is better to keep your money with me or lend money to me rather than lending money to the markets. So at the end of the day, by increasing reverse repo rate, what is the RBI tends to achieve? It is trying to ensure the credit supply in the economy would reduce. In a way, it is trying to go for a tight money policy by increasing reverse repo rate. So in simple terms, the RBI is simply telling the banks, rather than lending money to the market and getting exposed to the credit risk or a default risk, it would be safe for you and I am willing to pay you a higher rate of interest for the money you lend it to me. So as a result, the banks would think, rather than getting exposed to the market risk, I mean to say credit risk or default risk, it is always safe to keep the money with the RBI, and that money in the RBI is very safe and is also going to pay me a very decent rate of interest. And that's how RBI, by increasing reverse repo rate, goes for tries to signal the economy that it is going to go for a tight money policy. And if RBI decreases reverse repo rate, imagine the RBI goes for decreasing reverse repo rate, what is it trying to signal to the banks? For the money you happen to park with me, you get paid a very low rate of interest. So in a way, RBI is trying to discourage the banks to keep their money with the RBI, and as a result, what happens? The banks, rather than keeping money with RBI, they would be happy lending money to the markets. So by increasing reverse repo rate, RBI is trying to go for signaling contractionary policy. By decreasing reverse repo rate, the RBI is trying to signal banks that it is better to lend money to the markets. That's how increase in reverse repo rate is an indication of contractionary policy, and decrease in reverse repo rate is an indication of expansionary policy. So in simple terms, my dear friends, it's very easy to remember this fact. Increase in any rates, whether it's a reserve ratio, I mean CRR, SLR, repo rate, bank rate, reverse repo rate, increase in any rate is a tight money policy, results in a tight money policy. Decrease in any of these policy rates, I mean policy rate, I mean just a repo rate or reverse repo rate or bank rate or CRR, SLR, decrease in any of these things would result in easy money supply. That means the banks would have more money to lend, and as a result, they would charge less rate of interest upon the loans extended to the markets. So that's what I happen to keep it. So I am just comprehending it here. So what is the repo rate? The rate at which RBI lends money to the banks, or the rate at which banks borrow money from the RBI. What is reverse repo rate? The rate at which RBI borrows money from the banks, or the rate at which the banks keep their money with the RBI. So in both the cases, whether it is a repo rate, reverse repo rate, increase in these rates results in a tight money policy, decrease in these rates results in a easy money policy. So in this particular session what we discussed is certain instruments of monetary policy. One is the reserve ratios, that is cash reserve ratio, SLR, what do they mean, and the term assets, liabilities, debt demand and time liabilities, and how RBI could influence the supply of money either by increasing the cash reserve ratio or by simply by altering the cash reserve ratio or the statutory liquidity ratio. And later we discussed one important concept, that is what we call liquidity adjustment facility. So in a way the RBI is trying to adjust the total liquidity in the markets. How come? By influencing the so called policy rate, that is repo rate. So whenever RBI tends to rise the rate of interest, the rate of interest it charges to the banks would end up simply charging higher rate of interest to the customers, thereby signaling the market that RBI is going for a tight money policy. Whenever the reverse repo rate happens to be increase, the same thing holds good. The banks would be keeping more and more money with the RBI, and as a result the RBI is trying to again signal to the markets the RBI is going for a tight money policy. So at the end of the day, I just want you to remember the simple fact: increase in any of these policy rates results in money becoming tight, decrease in these things would result in money becoming cheap. As a result credit supply increases. So finally, at the end of the day, what I just want to remember, tight money policy or contractionary policy is to help in containing inflation, because that discourages people borrowing and spending, whereas easy money policy would help in boosting demand, thereby promoting growth in the economy. So that's what we discuss as part of this session, and the next session we'll try to understand certain other policy instruments, something like bank rate, and then the standing deposit facility recently been introduced by the bank, and then we have one more instrument called marginal standing facility along with bank rate is what we will be discussing, and we will also be discussing the concept of open market operations and quantitative easing and the impact of such kind of policy tools. And we will also discuss about what kind of impact that monetary policy initiatives or actions would have on the economy, and does these monetary policy actions would have any influence upon the economies outside outside their respective domestic territories. That's what would be the discussion in that what would be our next part of discussion. So I think you understood what exactly is the tools of monetary policy. Thank you.